Hello and welcome. You're with us here on Business Today. I'm Abha Bakaya. Here are the day's top stories. From soft drinks to soaps, Mukesh Ambani's Reliance cuts FMCG prices by 30 to 35%. Will it trigger a price war? Markets kickstart the last trading week of FY23 on a choppy note. Pharma stocks gain, realty drags, broader markets underperform. Our market guru Nilesh Shah of Envision Capital says the Nifty could retest June 2022 lows of 15,000 with a recovery by the year end if the US stops hiking rates. Industry surprised with taxation changes for the mutual fund industry, says Bala chairman AMFI. Direct tax collections are on a roll and may be 5 to 7% than even the revised estimates of 16.5 lakh crores for FY23, say Finance Ministry sources. After stirring a price war in the soft drink segment with the relaunch of Campa earlier this year, billionaire Mukesh Ambani-led Reliance has now entered the personal and home care segment, offering products at up to 30 to 35% lower price. My colleague Arnab Dutta from Business Today magazine joins in to share what exactly the move does for the country's 5 lakh crore rupee branded FMCG market. Arnab, after Jio's telecom price wars, what's the Reliance game plan in the FMCG space?
Given the kind of action that is happening in the market, because Reliance has already invested over $1.1 billion in acquisition of brands and partnerships as per a recent report, and it is expected by Morgan Stanley and JP Morgan that it is going to invest another $4 billion in over the next 3 to 5 years, which is equivalent to 33,000 crore in today's currency terms. So that is a significant investment that they are making in the market. Competitors in the market like other leading players, FMCG players, are obviously taking note. Like for example, very recently Mr. Varun Bedi has said that he is closely watching the development that Reliance and the new products that are coming up from the behemoth. And secondly, if you look at the Reliance's game plan, they have not only purchased new brands or launched new products, but they have also hired some of the key industry veterans. Like for example, they have hired Mr. K. Krishnakumar to head their beverages portfolio, which now includes Campa Cola, a well-known brand from 1970s and 80s. So, of course, industry competitors like HUL and others are obviously watching the developments very closely, and given the kind of price that Reliance is offering in competition to these leading multinationals, of course there could be some price cuts by them as well, the industry insiders tell us. And if you notice that HUL, after cutting pack sizes significantly over the last 2 years due to inflation, they have now started to increase their pack sizes in terms of grammage. They have started to increase the size of their packs at the same rate of late in the last one and a half months.
Arnab, what about the big daddies of the FMCG space, the likes of HUL, ITC, P&G? How are they likely to respond? Is a price war in the offing?
Yes, FMCG leaders in the market, which are now competitors of Reliance Group in this space, have of course started taking note of it, because in the last 2 years the kind of action that has been observed in the market have come mostly from the Reliance Group, be it acquisition of new brands, be it launch of its own products and brands, or be it expansion of its warehousing and supply chain capabilities. So as per Morgan Stanley's report, that they have already invested 1.1 billion rupees in the Indian market to make such acquisitions or partnerships in the FMCG space. And the analysts now believe that Reliance is going to invest another $4 billion, which is equivalent to 32,000 crores in the market to develop its FMCG business over the next few years. And that is a very significant amount that we are talking about. So if you notice in the very recently, Mr. Varun Beri, who is now the managing director and vice chairman of Britannia Industries, has said that he is watching the developments very closely. And also Reliance is not only just launching new brands, it has also hired some of the key industry veterans like Mr. T. Krishnakumar, who is the immediate former president of Coca-Cola India, and he has been very instrumental in developing Coca-Cola's bottling and supply chain operations in the country, has been hired by Reliance to head its beverages business. So of course industry competitors like Hindustan Unilever, ITC and others must be watching very closely, because Reliance is very aggressively expanding its presence into their homeland basically.
All right, Arnab, thanks so much for joining us. Now, Indian markets kick-started the last trading week of the financial year 2023 on a choppy note, while benchmarks ended in the green but gave up most of the day's gains. The Nifty could not hold the 17,000 mark and shut shop 40 points higher at 16,985. The Sensex, on the other hand, ended the day higher by 126 points at 57,653. The top gainers on the Nifty index were Reliance Industries, Grasim, Cipla, Divi's Labs and Maruti, while Adani stocks including Adani Enterprises, Adani Ports, M&M, Axis Bank and Power Grid were the top laggards. Global stock markets could correct between 5 to 10%, and the Nifty may retest the 15,000 mark, says market guru Nilesh Shah. Here's a slice of that exclusive conversation with BTTV Global Business Editor Uday Mukherjee.
How is the market looking, Nilesh, to you now? Because there's been so much turmoil globally over the last few weeks about, first with Silicon Valley Bank and then with Credit Suisse, and now there is talk of Deutsche Bank being in some kind of trouble. At least that's what the stock market there is indicating. What's the end game of this? I mean, everybody has noted that this is not 2008. Regulators are aware of the risks and they're moving in a certain way. But, do you see this ending in an episode of a bad accident or something like that, which makes 2023 a very poor year for equities again?
Well, there is certainly a lot more turmoil in the global marketplace and in global financial markets, and a lot more than what one could have imagined. I mean, I'm quite sure at the start of the year we never thought that there could be bankruptcies along the way, especially of banks. But the challenge in terms of the US Fed hiking interest rates that has spilled over to the banking system, I think is a bit abrupt. It's been a bit sudden, and it surely has huge ramifications. I think what matters in the financial markets is stability matters a lot more, and that's essentially getting kind of the boat is getting rocked right now. So clearly, from a global sentiment point of view, I think things aren't looking great, and I suspect that this will probably go on for a few months, and it could pretty much it has already taken center stage, and it could pretty much hog the limelight and impact sentiment for pretty much maybe another 1 to 2 quarters at least. We're already about 10% off. Our own markets are off about 10% from the recent highs, and it's quite possible that with the way the global markets are positioned and the way a risk of trade could further accelerate from here on, it's quite possible that we could probably correct another maybe 5 to 10%, which could pretty much take us to the lows of 2022. In June last year, we had gone to about the 15,000 plus on the Nifty, and I wouldn't be surprised if those levels were to kind of get revisited. So yes, it's going to be a lot more somber year, a softer year. It's going to probably be a year, at least for most part, which is going to kind of look negative. But it's quite possible that maybe towards the end of the calendar year, we could reclaim a lot of the lost ground, especially if things don't turn out to be too bad, or the US Fed decides not to hike rates further. If our own policymakers here decide to not hike rates further, then again, it's quite possible that the markets could stage some recovery towards the year end. But it looks like that it's going to get a little more worse from here before it starts to kind of look better.
If the market were really to get down to those Nifty levels of 15,000, what's the best way to position yourself now, Nilesh? Do you think mid caps and small caps will get hurt more than large caps because they've already underperformed quite significantly? Do you see the underperformance there getting even more aggravated if the market falls another 10% from here? And conversely, you know, the high quality, very expensive stocks, you know, all those Asian Paints and Bajaj Finances of the world, they have underperformed very significantly over the last 1 year or more. Do you think that style of investing can come back into vogue again as people seek hiding places?
Well, the high P space, I think is set for an extended period of underperformance. That's the space which I think you know, investors are already beginning to question whether you need to be assigning those lofty multiples of 60, 70, 80 times for businesses which probably still are kind of growing at about 10-15%. If you were to kind of look at any of these names which have been quoting at these premium valuations, and their growth rates over the last 5 years, over the last 10 years, have probably at best been about in the mid-teens in a best case scenario. So I clearly believe that's the space which is going to get challenged. In the intervening period, the mid and the small caps could face a bit more brunt, and that's purely because of the risk of trade accelerating, and when there is risk aversion, you clearly see the mid and the small caps to kind of underperform a bit the way they have underperformed over the last maybe few quarters. But having said that, they are probably getting into a zone of undervaluation where probably valuations have already become reasonable. They probably could become a lot more reasonable with another 5 to 10% correction. And I do expect that by the end of the year and starting of next year, the markets to again go back into risk on. And once that happens, mid to small caps will outperform quite significantly. That's the nature of the beast. We've seen these kind of cycles earlier, be it 2018, be it 2013, be it 2008, where mid to small caps did face the brunt, but post that, for the next 2 or 3 years after that, clearly mid caps and small caps did outperform by a huge margin. And I wouldn't be surprised if a similar cycle repeats itself, especially if interest rates peak out and interest starts to kind of be cut again. My sense is mid to small caps will start to do well. In addition to that, an interesting pocket of the economy, which is the infrastructure space, the capital goods, capex, engineering products, that's the space which is witnessing better earnings growth. And you find a whole bunch of them in the mid to small cap space. And that could provide strong leadership, especially to the mid to small cap space. So I clearly see money moving out and continuing to move out from high P to more reasonable P. And then later on, from the end of this year or maybe sometime next year onwards, money move out from large caps to more of the mid to small caps.
Watch the full exclusive show on our YouTube channel, Business Today, as well as our website, businesstoday.in. The recent amendments to taxation of debt funds has delivered an unexpected blow to mutual fund investors, with inflation indexation benefit granted to long-term investors in debt mutual funds being removed. My colleague Sakshi Batra spoke to A. Balasubramaniam, MD and CEO Aditya Birla, Sun Life AMC, and Chairman AMFI to find out what this means for the debt mutual fund investors and the industry.
It's been a very, very eventful last weekend for you, and I'm sure especially for you, your phone wouldn't have stopped ringing. For a whole lot of people would have been wanting to understand from you the impact of all of this. So I wanted to take first your reaction. What was your first thought when you heard about this amendment in the finance bill? And as per your understanding, how will this really change life for AMCs at large, and what will be the impact of this on the total assets under management for AMCs?
Yeah, no, thanks Sakshi for having part of the show today. I think first reaction as we came to know on Thursday night that there is an amendment that is being now introduced in the finance bill. Of course, all of us were taken aback and surprised that how come this has all of a sudden has come and was not being part of the budgetary provisions. And then of course we try to understand what is the background from which it has come, and is there anything that can be done by way of making representation through AMFI as well as SEBI. While that's an effort that we are immediately getting into action in terms of what we can do. But having said that, then as the amendment got passed in the parliament, then naturally we have to make an assumption that that the amendment has now become final, and therefore we have to live with for the time being what has been presented. I think what came as a surprise is given the fact that Indian mutual fund industry have been growing at a very steady state of growth, and having close to about 16 lakh crores coming in the fixed income out of the 40 lakh crore that Indian industry has been managing. And the mutual fund also been playing the role of one, channelizing the savings into the capital market, both in equity as well as in fixed income. At the same time, provides a greater depth to the corporate bond market in the country. And we have been a provider of one of the source of financing for most of the company needs, and we have been doing. Therefore, these taxations introduction was a big surprise for us, given the fact that the role that we are playing actually benefit both investors on one side and the capital market on one side, and third is the corporate bond market development on the other side. Therefore, we are a bit surprised, but anyway, government has gone by that assumption that we need to have a uniform taxations across all products, across all industry players. I think probably the finance minister has been living up to her own the effort that she is taking for simplified tax structure. So going by that, I think they seems to have taken it in the final bill when they were getting amended.
Right. So are you hopeful for a review, or do we have to live with this for the time being now?
I think the way I assume is unless there is a provision that they can that they can use it for reversing what they have done, but it looks doubtful to me given the fact that it got passed in the parliament. Anything that got passed in the parliament, I would assume that become sacrosanct. If at all it has to get reviewed, probably it can get reviewed the subsequent budget. So I assume unless the actually whatever the representation, that noise that has been made by all the industry players and including regulator giving some kind of data points on various things, if it makes their mind change a bit, then we are going to be surprised.
How should a fresh investments be taken from FY24 in terms of the debt or fixed income instruments? What would you advise to the conservative investors out there?
See, I think conservative investors, those who come in the low tax bracket, they can of course continue to be in the FD, and given the fact that gives them some bit of guaranteed return, and there's the element of safety which they always consider. And those who come in the higher tax bracket, and those who have high income payers, income tax payers, so definitely mutual fund would still be a better option, given the fact they do get short-term capital tax benefit, can be adjusted against the short-term capital loss, and everybody thinks actually they only make profit all the time to pay tax. People also make losses actually in their investment, as we have seen recently the equity market volatility. So therefore, it's always better to have that options with them. And naturally, from SMEs and corporate investors' point of view, I think mutual fund will continue to remain a vehicle, but they don't actually come for LTC benefit. They always come for parking their money as a better alternate to any other investment that we have. I think that segment will continue.
India is likely to record 5 to 7% higher direct tax collections, and even the revised estimates of 16.5 lakh crores for the current fiscal year ending on 31st March. My colleague Karishma Sudani joins in to share more on this. Karishma, why are direct tax collections going to be higher? That's even more than the revised estimate.
Well, right, the impact definitely is seen on a positive note, because robust revenue collections are any day good for the centre's calculations, especially of the fact that after the recent budget, they had to revise the estimate by close to 20 to 25%, which means that they were already confident of the fact that direct tax collections from the net perspective is going to do exceedingly well. And that is what we are picking up from our sources. While it's just few days away that the official numbers will come out, we've been told that government is sure of the fact that it will cross the 16.5 trillion number that the government had estimated in its revised estimates. In fact, there is also a strong possibility that it could take over that number and surpass by another 5% hike, because we know that March is the month where maximum collections are seen. It's the closing year for most companies, be it annually or quarterly, and that is why also with the advanced tax collection numbers, government and centre is confident that direct tax numbers will fairly do well.
Thanks for that, Karishma. Now, the ongoing tech slump has resulted in mass layoffs and a slowdown in hiring across big tech companies and massive layoffs across the board, with many Indian employees being let go. What can be expected on the hiring front in the next fiscal year? My colleague Akanksha Chaturvedi spoke with Vijay Sivram, CEO of Quest Corp, to understand better the hiring trends likely for FY24 and whether the AI-led disruption would further hit IT jobs.
Lately, we are witnessing a slew of layoffs across the tech and startup sector. Will this spill over to the IT sector, especially Indian IT companies as well, since they've lately been facing headwinds?
Well, I think great question to start off with. I think there will be headwinds, of course, within the IT sector as well. You must understand that the premise at which this is happening is caused by multifold reasons. One is, of course, this is a recessionary fear that's gripping the world. There's this inflated employee-led costs because of the surge in hiring that happened a couple of years ago. The funding winters that's not allowing the startups to really kick off the way it's supposed to. And also a lot of incubated projects not seeing the light of the day. So obviously there is that extra pressure that will come across, and India being the host of a large amount of tech talent will not be severed away. But what I can tell you is that a large part of these impacts may hit the developed markets more than what it would be for the Indian market.
All right, sir. But what about BFSI and IT? Especially as we see, major IT companies in India have a lot of exposure to the banking crisis going on in the West. Is hiring going to slow down for BFSI verticals, or are we going to see layoffs in the time to come?
See, overall, the IT sector, Akanksha, has seen a little bit of a slowdown already. So if you notice the last quarter or more, there has been a slowdown in the overall numbers that have come. So in terms of overall spend, definitely there will be a little bit of a little lesser spend from IT point of view from banking and financial services sector. But I would not want to call out the recent banking stories that have come out or the crashes that have come to be representative of the banking industry overall.
So we are seeing a drop in fresher hiring amid campus hiring rounds and all. Is it because companies are focusing on mid-level talent via lateral hiring, or is there something else at play here?
See, I think many of the times when we compare the fresher hiring and even to the fair amount of the lateral hiring as well, we compare it to last year. Now, last year, you must understand, Akanksha, was an anomaly. It was a surge that was not seen in the years before. So when we compare it to last year, definitely you may see a dip. I think what organizations should review and what people should review is where the fresher hiring was at a pre-pandemic stage. So the last two and a half years has been a complete anomaly. There's been a COVID which is completely deep dive in terms of hiring, and then there was a surge of technology demand hiring that happened last year. So I think we should compare ourselves to a pre-hiring, and if I'm not mistaken, as per at least from what our data states, the fresh hiring has not come down from a pre-pandemic state. It may have come down from a last year's surge, but you must understand that there is also a large amount of freshers that they have hired last 2 years. And these freshers are now getting trained and have to be deployed, and in terms get billable in the case of the services segment. So you will see some form of utilization metric coming into play. And for those organizations that have not been able to fully utilize their fresher hiring, may slow down. But on the other hand, you might find that this is also a huge cost play and a brand play. So you will see organizations still visiting campuses, but may not be comparative to the last year.
And that's all we have time for on the show tonight. Thanks for watching.